This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Patrick, let's dive into the post-game chart deck, which is titled Correction or Crash. Listeners, you find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, click the red button that says Looking for the Downloads. Patrick, looking at page 2 here, we got the S&P 500 continuous futures chart. What's going on here?
Right. So obviously it's not a crash yet. This is up to date, just a correction, at least by the traditional means, a 5% correction that's now done a 50% retracement of its prior rise down to that 50-day moving average like you were talking about in the market wrap at the beginning. And so far that it seems like a clear setup to be bought on dip. But what was interesting is that once you look under the hood of the market and really dig a little bit deeper, there's a much more interesting story going on beyond underneath the surface of the index. And so when we go to page 3, where I have the VIX. I'm just going to go through a number of these charts on equities to kind of just really take a dive into what's going on here. We have a VIX that has now jumped to a 6-month high. I mean, the last time we saw the VIX in this 30 area was back at the start of the year, back in January, February. And when the VIX traditionally reaches these kind of higher elevated levels, it usually does one of two things. It either signals a great opportunity to buy the dip, or it turns into something more ominous and there's some significant tail risk emerges in the markets. On balance of probabilities, you always want to anticipate it's more probable that it is bought on dip. But it is a very sensitive moment where right now volatility is elevated and the risks are heightened. So when we move on to page 4, this is where I wanted to really highlight what has been going on under the surface. And really what we continue to have is a deja vu a few years ago where the FANG stocks, which are these big market cap behemoths weighting huge into the index, are actually holding the S&P 500 market cap weighted index up much higher. And when you look at something like the same S&P 500 stocks but equally weighted, the market correction's been much deeper, and pretty much the equal weight has given back almost all of the gains it has made since the that short-term October bottom that led to this rally here. And so really the breadth has been deteriorating. This is evident in a number of other charts. And so I want to start on page 5 by looking at the New York Stock Exchange Bullish Percentage Index. And this is simply using the traditional point figure charting technique to determine all of the stocks on the NYSE, how many of them are in bull signal versus a bear signal. And what we have is over the course of the year, a continuous deterioration of the bullish percentage index, including this current breakdown has now broken almost 18-month lows in terms of this, where only 43% of stocks on the NYSE are actually giving a bull signal. And that just shows just how weak the underpinning stock market is beyond the indice that's being held up so well by those FANG stocks. Another great example of that is on page 6 when we look at the percentage of stocks on the New York Stock Exchange trading above their 50-day moving averages. We are down to 22%. That's implying 78% of stocks are actually in a downtrend based upon their the 50-day moving average. And what's amazing is that usually whenever this kind of a breadth indicator gets this oversold, it often signals a buy on dip opportunity. And yet the S&P itself is only 5% off of its highs, and yet we are oversold to such a magnitude that only the coronavirus crash itself in March had anything of this magnitude. It really is a tale of how divergent these markets are.
Patrick, moving on to page 7, you're dividing the Russell 2000 by the Nasdaq 100. What's the story there?
Well, again, that's just another supporting chart of the case that I was continuing to make, which is that the NASDAQ, particularly the FANG stocks of the NASDAQ 100, continued to do incredibly well and hold up very well, while the majority of the stock market, in this case I'm using the basket of small cap stocks, just continue to show how the NASDAQ outperforms the Russell. And this has not only been the case since the March peak, but this breakdown in the last few weeks continues to demonstrate that relative outperformance.
And moving on to page 8, we've got the Euro-US dollar cross. What's happening there?
Well, like we were talking about in the market wrap, I found it really interesting that typically we have seen in the past, more often than not, that the dollar in a risk-off cycle responds with a rally. And we usually would see the areas like the euros actually weaken. But what is really interesting is that we have seen the opposite, or at least the dollar be non-responsive during this risk-off cycle, as we've seen in the last week when the market started to really, and oil started to get really hit. The dollar actually has been almost backfilling or retracing, in this case the euro bouncing, and it really doesn't seem to have that much of a strong response in the currency markets. And I'm wondering whether this is just some short-term noise, or whether or not the dollar will come back in line, particularly if the market starts to deteriorate from here.
And moving on to page 9, you've got a crude oil chart.
Right. And so we were talking about this in the market wrap, Eric. And one of the things here that when I look at this chart, it's amazing what 5 days does. Like we basically in 5 days of that oil plunge wiped out the entire August to November market rally in oil in one fluid motion. And while I do subscribe to your view that this is overdone, it's an interesting price level to be observing oil, because along the July and August lows is arguably some support, and with us now already being close to $20+ off of the highs, this would be an interesting level to be watching whether a short-term low is established. But what I wanted to highlight here, Eric, on page 10 is the term structure, and this is something that you typically spend a lot of time thinking about in your trading. But what's really interesting is that most of the damage in crude oil was really done at the front of the curve. And while we have seen generally the whole curve weaken during this cycle, one of the things that we've really seen is that really deep backwardation in the curve has started to flatten. And one of the interesting ways to look at it, on page 11, I have the spread between the January 2022 oil contract and the January 2024. So going a 2-year spread on the term structure, the spread at one point was $17, and that has recently dropped down to $6 during this whole drop. So we've just seen a substantial flattening of that term structure. It'll be really interesting to see whether this is where it really stabilizes.
Well, Patrick, what happened was we had a huge blowout of backwardation at the front of the curve. That was being driven by fears of Cushing, Oklahoma running out of oil. Then came the Omicron scare, and needless to say, that was all forgotten about. In fact, it was forgotten about before the Omicron scare, that backwardation was starting to come out of the front of the curve. Now it's collapsed completely. We're not into contango yet, but you never know what's possible. As far as what happens from here, it's really politics, messaging, and rhetoric. I think the market is already sold off in terms of both flat price and term structure. Way too much, but that doesn't mean it can't sell off even more before this is over.
All right. Well, I just wanted to wrap things up here by just showing the 30-year government bond yield. And what's really interesting, when we heard David talking about this during the interview, the bond has been doing very well ever since that March low, and which is the peak in yields on this chart. And what's interesting is with this breakdown, one of the bigger questions in my mind is this, and like the name of the slide deck, is this a correction or or is this the beginning of something more ominous? And whether or not the market gets bought on dip, it's really interesting to see whether the long bond continues to sniff out that kind of deflation side of the story, and whether we see yields head back down to 150 or 140, where we were just trading in late 2020.
Folks, if you enjoy Patrick's chart decks, you can get them every single day with a free trial of Big Picture Trading. Information's on page 14, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from bigpicturetrading.com, the Internet's premier source of online education for traders. Please visit bigpicturetrading.com for more information. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from bigpicturetrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.